Uh, let's get some more perspective in. Ritu Arora is joining us right now. She's a Chief Investment Officer at Canada HSBC OBC Life Insurance. Ma'am, good morning. Good to have you here. Prashant this side. What's your own sense?
Good morning.
Are we heading a lot lower from here?
Good morning, Prashant. Good morning. I think the global cues are guiding the market, and clearly there is worry around the globe, specifically in Europe, with the pound seeing the pressure. I think I would not be surprised if European markets opened lower. And with all the FII outflow that we are seeing and no real positive trigger on the domestic side, I believe that the pressure on the markets is likely to continue for the next couple of months, till such time as domestic economy shows the strength and the resilience to pull the market back on a bullish trajectory.
No sign that that is likely to happen anytime soon, right?
Budget, of course, has a potential to be a huge positive trigger, but other than that, at this point in time, I think the macroeconomic fundamentals for the country have been falling in place, but they do not reflect in the corporate results, they do not reflect for sure in the bank results, and hence till such time as we don't see some improvement in the domestic economy or something changes fundamentally globally, I don't see a trigger that I could count on. But budget can be has the potential to be a big positive surprise.
You're saying it has the potential. Most of the expectations that one is talking about now leading up to the budget are kind of pessimistic in nature. You know, capital gains tax being tinkered with, something on dividend distribution tax, so fiscal slippage. There are a few other things as well. Usually, you know, there's a run-up. The expectations are built up, you know, positive news flow, hopes. Of course, post-budget all comes to naught, mostly, usually. But this time, expectations themselves are quite pessimistic.
So, Prashant, it's always easier to give relief to someone who's pessimistic than to excite someone on the optimistic side. So, if we indeed do not see the government adopting excessive revenue spend kind of a number, capital gains tax, which is a big worry for the market, does not fructify the way it is, I think we would see a relief in the market and some rejoicing. May or may not really be a sustained bull rally from there, but relief for sure it has a potential to provide, because there's a lot of pessimism that is being built in. The mood is dull, everything and everyone seems to be quite trapped in negativity, and hence some kind of a relief might be that positive trigger which the budget can provide if it doesn't really turn out to have all the negatives that the market is counting as of now.
You know, you manage really long-term money, insurance money. People, of course, many have that kind of time horizon, putting their money to work themselves as well, but most don't. They want to see returns in a reasonable time period, you know, 2 years, 3 years. Time period. They want to see themselves making money, meaningful money. You think with that kind of time horizon, 2-year kind of time horizon, these spread we can go down another 10-15% easy from here?
Time horizon.
Yeah, go on, sorry.
If we look at the market from the lens of valuations, we are still not very cheap. While we have seen correction in line with the global markets, we are still about 17 times, and that is not a cheap market. And hence, if we see a bit of correction from here, 10-odd%, it is possible. One cannot rule that out, considering the negativity around, the gloom around. Having said that, I don't think we should see a very sharp correction from there. So with someone who has a 3 years time horizon, and 3 years is a very reasonable time horizon to have, I think it is good time to start investing specifically in values. In terms of, when I say value, I'm talking of not value picking, but I'm talking of visibility around good quality corporate results, which are very far and few in between, where there's earnings visibility, brands are strong, cash flows have sustained this tough environment, and the balance sheets have the strength to rebound and grow if the demand returns. So it is good time to invest in those kind of stocks. I would stay away from recovery plays, cyclicals, because they may still be under pressure till such time as we don't see, and that could be a little while away. But in fundamentally strong companies which are now available at much more attractive valuations, most definitely it's a good investment opportunity which doesn't come by very often.
Would you, right, would you mind naming a few? But, you know, and also you said, well, we trade about 17 and a half times, which is still not cheap. So maybe it's better to wait, prudent to wait a little bit more, right?
I would think all investors who are using institutional means to garner and to invest their financial savings, be it through mutual funds or life insurance, should not get into a mode of discontinuing SIPs and wait and watch kind of thing. Premium should be paid in because there's no way that anyone can time the market, and the entire strength of SIPs lies in investing through the good days and the bad. So hence those kind of investments should not stop. But if retail investors are looking at making direct investments into the market, I would think it is a good time, a prudent time to reflect, pause and evaluate what they hold in the portfolio and take decisions over next couple of months. And budget definitely should not be something that retail investors should play for. They should wait to see what the budget and how the budget unfolds, what are the announcements, and invest in good quality stocks which have earnings visibility, because at least the returns around earnings growth will be there in the portfolio at that time, and you can't go wrong when you invest in quality.
Yeah. Any specific ideas you want to talk about? Any specifics when you don't want to talk about stocks, maybe sectors?
It is really not an environment for sector allocation. It is very much an environment and a market where stock picking and bottom-up stock selection is of importance, because within the sector there is wide variation in the way the company results have played out or the stocks are performing. Having said that, I still like, and since earnings visibility is a theme I'm saying that I am confident about, I would find stocks in pharma sector, IT sector, which still give me a reasonably good earnings visibility. I have liked automobile sector, hasn't performed that great in recent past, and so strong companies there to me look like a good opportunity to invest in. Those are the kind of sectors. I still like private sector banks, especially the ones which are retail focused. They continue to do better than their PSU and other banking peers. So private sector banks still look good. So, but it has to be very selective, stock specific. One cannot paint it with one brush and say all private sector banks are good. One needs to go down and actually evaluate each stock. So I repeat that each stock selection by retail investors needs to be done with a lot of care and diligence.
All right, ma'am, thank you very much for your time. It's good speaking with you. Appreciate you joining in with that perspective today. Thank you indeed. Okay.